I'm Harry Colvin from Longview Economics. This is one of our quick take videos. This week we published an oil piece ahead of OPEC's announcement that they plan to cut 1.2 million barrels per day in production. We had a 9% rally in oil and a further flattening of the WTI curve. The question on everyone's lips is whether or not this upside momentum in oil is likely to last. In the long term, the answer is probably yes, given that we've had such a large collapse in energy sector capex around the world, as well as high and rising decline rates. The history of commodity supercycles shows us that whenever we have big bear markets coupled with a collapse in capex, that sows the seeds for the next uptrend in commodity prices. In the near term, there are a number of factors that question recent upside momentum in oil, things like a strong uptrend in the dollar, as well as the likely return of US shale production if oil squeezes higher by another $5 to $10. The other factor and the focus of this piece is that Chinese oil demand is simply not growing. We've got two key models in the note to illustrate that point. The first looks at petroleum product consumption, shows that it hasn't been growing for 12 months, and that's backed up by other evidence. Reports from PetroChina and Sinopec to show that sales of domestic petroleum product are not growing, road freight volumes are shrinking. The other key model is our stockpiling inventory model, shows that whenever oil prices rally, China backs away from stockpiling and destocks. Whenever they fall, China stockpiles again. So another move higher of $10 to $15 in the oil price, we'd expect China to dial down their stockpiling activity, and with that undermine the key source of global demand, which is China, which is their stockpiling of inventory, because of course underlying demand is very weak. Do take a look at the note. If you haven't got it, ask for it and we'll happily send it through. Thanks.